If you're looking for a black swan, it probably lurks somewhere in the real estate market.
Manhattan's commercial real estate crisis is getting worse.
94 million square feet of empty office space in Manhattan. That is an all-time record and equal to 37 Empire State Buildings of empty space.
The office vacancy rate in LA soared to 22.5%.
$1.5 trillion in commercial real estate loans expire in the next 2 years.
America is in big trouble. Let's look at New York City. More specifically, 1740 Broadway, between 55th and 56th Street in Manhattan. Here's where you'll find a 26-story tower owned by Blackstone that's up for sale. The $308 million mortgage is up for sale after the private equity group defaulted on debt more than a year ago. The debt, which is packaged into a commercial mortgage-backed security, is being marketed at $150 million. That is a 50% discount. The building was appraised at $175 million in April, down 71% from $605 million, which it was valued at in 2014. In New York, you're seeing an increase in more and more commercial buildings going into foreclosure. Office owners are being dealt with a market slammed by higher borrowing costs, declining valuations, and a rise in remote work. Some are choosing to walk away from buildings, while others are opting to extend debt and hold on to properties. And it's the same all across America. A new report by the Financial Times shows $117 billion in commercial real estate office debt, which needs to be repaid or refinanced this year. As you can see with this graph, majority of it is focused on the major cities: New York, San Francisco, Chicago, and Los Angeles. With having far stricter lending standards, this could be proved to be much more difficult, hence the potential of the Blackstone situation happening at a more frequent rate.
Real estate equity REITs are going to be in trouble. They're going to get, a lot of them are going to get wiped out. So many defaults. I think $700 billion could default, right? The lenders are going to have to do things with them. They're going to be selling. It's going to be a generational change in real estate coming. End of 24 and all of 25, we will be talking about real estate being just massive change. $700 billion to $1 trillion in defaults coming.
Moody's Analytics estimates that about 605 office towers with mortgages will need financing this year. Of that, about 224 will have trouble refinancing. This is because property values have plunged and there is too much debt and too high of a vacancy rate. Delinquencies on office loans financed by commercial mortgage-backed securities topped 6% at the end of November, up from 1.7% a year earlier. Lender losses on commercial property loans have started to rise and look poised to increase farther. Fitch Ratings projects the delinquency rate of commercial mortgage loans will increase to 4.5% in 2024 and to 4.9% in 2025. That's more than doubling the 2.25% rate in 2023 as of November. Retail, hotel, and office delinquencies are all expected to increase. It won't happen overnight, though, as in 2022 and 2023, many owners were able to exercise a 1 or 2 year extension built into their original loans. In 2023, $541 billion in debt, backed by office buildings, hotels, apartments, and other types of commercial real estate, came due. This was the highest amount recorded ever for a single year. Unlike home mortgages, whose principal is paid off over time, most commercial mortgages are interest only. That means that when the debt matures, the borrower has to refinance or pay off the principal. The decline in inflation and interest rates in recent months has definitely eased the pain. But most borrowers still have TORA finance at much higher rates than those of their maturing loans. Rate cuts really cannot come sooner for the industry. We all remember last year when Brookfield defaulted on $784 million in loans for 2 high-profile downtown Los Angeles office towers. They simply just didn't have the cash to pay the loans. More and more people are working from home. This is leaving offices completely empty. The U.S. office vacancy rate is at an all-time high. Ask commercial real estate reels from remote work arrangements. At the end of 2023, America's office vacancy rate stood at 19.6%. When you look at the individual cities comparing 2019 to 2023, it's very concerning. San Francisco change in vacancy rate was roughly 20%. This was followed by New York's Midtown South at a 14.2% change. Austin was equal second with a 14.2%. It's anticipated that by 2030, over 300 million square feet of U.S. office space will be completely unused. This graph shows it best. As you can see, supply of new office real estate has been dropping since 2022, down 67% year over year. At the same time, vacancy rates have rapidly increased. This is also not helped by the fact that 35% of U.S. workers who can work from home in 2023 are already doing so. Unless the trend reverses, offices in many U.S. cities will stay completely empty. Companies are essentially threatening their employees as Amazon tells its corporate staff that they're risking future career growth if they continue to work from home. Similar tactics were used by Google, as they used in-person office attendance as part of employee performance reviews. This is asking the question as to whether the golden age of remote work is now over. So, is the industry facing complete doom and disaster? New York City is implementing a program with the aim of converting 46 commercial real estate buildings into housing units. The program seeks to expedite projects that involve changing workplaces, many of which were bustling before the 2019, but now sit empty amid a global shift towards remote work. The goal to change them into residential housing, creating new homes and good jobs in Midtown Manhattan. It was found that 15% of commercial office buildings located in the 105 largest U.S. cities are suitable for residential conversion. Inflation still has rents at historic highs. For instance, the average rent in Manhattan in September 2023 was $5,552 a month. That's 32% higher than 2019. A recent survey from the Mortgage Bankers Association found missed payments on loans backed by office properties jumped to 6.5% of balances at the end of the fourth quarter, up from 5.1% in the prior quarter. Some experts are claiming that office prices will plunge a further 20 to 40% in value next year, which will take decades to climb back to its current highs. The commercial real estate market was changing well before 2019 with the transition from brick and mortar to e-commerce. Retail is becoming increasingly hybrid, blending physical stores with e-commerce. Technology, particularly AI and machine learning, is reshaping retail, with self-service kiosks and online shopping platforms becoming more crucial. Marketing is shifting towards a mobile-friendly model, with social media and influencers playing significant roles in customer engagement. Retailers are expected to innovate and continue to pursue an e-commerce strategies in the near future. More recently in the Netherlands, we saw that there were more online stores than physical stores. Online stores had a 4.1% increase from the previous year. Physical stores have seen a decline, particularly in clothing stores, which decreased by 16.2%. Online stores with a general product range are experiencing the highest growth at an annual rate of 32.3%. But what about America? It is expected that by 2040, 95% of all purchases will be made online. Online sales have surged 300% since 2001. This at the same time where department stores have halved. It is clear that brick-and-mortar stores is a dying business, and e-commerce the future of retail. Hence, we could see even further distress in the commercial real estate sector. Despite interest rates coming down slightly, we expect 2024 to be another painful year. The commercial real estate market is expected to face further challenges in the coming year, with property values projected to drop by 10% after an 11% decline this year, as per a report by Capital Economics. The market, valued at over $5 trillion, will see a significant reduction in value, with office and industrial sectors being the most affected. Office spaces are grappling with structural changes in work patterns post-pandemic, leading to negative job growth and underutilization of space. Office vacancies are expected to peak at 20.5% by the end of 2025. Apartment values are also predicted to fall due to affordability issues and an influx of new units. However, retail is seen as a potential bright spot with an anticipated annual return of 6%. Industrial property values are forecasted to drop by 20%, with negative returns expected next year. Interest rates are expected to decrease, which may alleviate some pressure on property owners. As of early 2024, the commercial real estate sector is navigating a landscape that has been significantly shaped by the aftermath of the pandemic. Economic factors such as rising interest rates and inflation have had a significant impact on the commercial real estate. Higher borrowing costs can dampen investment activity and affect property valuations. Investors and developers are closely monitoring these trends to make informed decisions about acquisitions, developments, and portfolio management. Overall, the commercial real estate sector is in a state of flux, with traditional models being challenged and new trends emerging. Stakeholders in the industry are focusing on flexibility, innovation, and resilience to navigate the current market dynamics and position themselves for future growth. Despite this, we are expecting this next year to be another really painful year for the sector. Let us know what you think about the current and future state of the commercial real estate sector.